Well, good evening.
Good evening. Can everyone hear us? Fantastic.
Okay, wonderful. You got it? Oops.
No. Good. Let me do our disclaimer first, a little bit of housekeeping before we get into this. This is for educational purposes only. We're not giving anybody financial, tax, or legal advice. And we're not offering any securities or presenting a deal, and nothing in these documents has been reviewed by the Securities and Exchange Commission because we do raise capital under their rules.
All right, so we are David and Stacy, and if you are new here or maybe haven't done any real estate investing yet, we were right where you are just a few years ago. But we joined Total Wealth Academy, and we have taken massive action to really change our portfolio completely. So a few years ago, I was an employee at a major oil and gas company, and David had his mortgage and real estate business that he had had for many years. And we were heavily invested in stocks in our 401k. But now our portfolio has completely changed, and our lives are completely changed through investing in real estate. So now there's several different ways to really get involved in real estate investing. You know, you can start out with a small property and scale up, or you can just go right into passive investing if you have the means. But for us, the way we got into real estate investing is to partner with great operators and to learn from them. We heard about the importance of mentorship and to raise capital for those great operators. And so we are general partners on 5 deals, about 800 plus units. And we're also a passive investor. So my 401k that used to be all stocks is now in alternate investments. So multifamily apartments, self-storage, and oil and gas. So complete transformation there. And so, thank you. It's good to learn from mentors, from people who have done this before and done well at it. And so I think we can all agree one of those is Warren Buffett. And so he has a rule that he shares, and his rule 1 is never lose money. And his rule 2 is never forget rule 1. But he and David and I, we have a third rule that we like to add, and that is never lose other people's money. And so David has, after literally hundreds of deals that he's underwritten, and going from just hundreds of deals to just identifying those few that are really the ones that are successful to invest in, he has developed a method. It's his signature method that's called DEAL, the DEAL method. So it's DEAL. It is an acronym. And so he's going to be going over that DEAL method for you. And so if you are a real estate investor, or you want to be, and you don't want to lose money, you'd rather make money, you're going to want to pay close attention to this DEAL method and take some notes maybe, and also ask some questions at the end. So I give you David.
Thank you so much. Thanks, Stacy. Thanks. Yes, so we are very passionate about passive investing. I think it's the greatest thing in the world. We are passive investors. We also invest in all the deals we participate in. And a little bit different, we don't operate. So there's a lot of great operators here in Total Wealth Academy. I strictly like to raise money for deals. I like to keep it simple and just deal with money, and I like to make other people wealthy. And the most important part of wealth building is not losing money, like we talked about before. So we're going to talk about how to not lose money tonight. So the DEAL method, the first thing, the D, is the debt structure, the loan type. Is it a fixed rate? What is the initial DSCR? And this is the first thing I look at on a deal when I'm looking at it. The second thing is the E, the experience or expertise of the general partner team, and what is their track record. This is the most important thing when we're looking at a deal, because a great team won't buy a bad deal, and they'll operate out of problems. The third is accounting, which is the numbers, returns, metrics, underwriting. Accounting is the only thing that started with an A for the numbers that I could think of. And the L is the location, the market, the submarket, and any risk associated with the different areas. So let's do kind of a deep dive on the debt structure and the risk involved in real estate. So with the debt structure, are you the first in line after the bank? So on the front end of the deal, I like structures where the investors are right behind what we call the senior debt or the regular loan. I don't like any preferred equity, second liens, or mezzanine debt on the deal on the front end. Does the business need a capital event in the first 5 years? And if it does, there could be a problem there because no one knows what future interest rates are going to be. And a lot of people got in trouble because they got into deals that needed a capital event. Is it possible that a capital event would be good? That's fantastic. If it needs one, that could be a sign you're taking excessive risk. And also never invest in a deal structure that you don't understand. If you don't understand the deal, ask questions, figure it out. And if you don't understand the deal and you can't get there, just don't do the deal at all. So on the loan type and term, I like a 7 to 10-year fixed rate debt, agency, HUD, bank commercial loan, commercial mortgage-backed security. As long as it's fixed for 7 to 10 years, I'm good with it. On a loan assumption, you want a minimum of 5 years left on the loan. So there's some deals out there where it's a 2021 or 22 or 2020 deal, and there's a 3% interest rate. That's fantastic, but make sure there's 5 years left on the debt to give you time to operate through it. And I'm going to make a firm statement, no bridge debt. I'm just not doing it. It's the first question I ask. If there's bridge debt on the deal, do not do it unless you are a really wealthy person and you love gambling and you don't mind losing money. For the rest of us, and probably everybody in this room, I just would not do it. It's just not worth the risk. No one knows what future interest rates are going to be, and variable rate is not something to be played with. It's very dangerous. So unless you've reached a point where you're very wealthy, I would stay away from that type of debt. I just don't think it's worth the actual risk. Also, deals need to cash flow or no go. Robert Kiyosaki has a great saying. He says, I'm a cash flow guy. If it doesn't cash flow right away, forget it. Don't even bring it to me. I don't want to look at it. So you want to find deals that cash flow now and are going to cash flow better later on. The way I measure that is the debt service coverage ratio. So in multifamily or single family, it's the ratio of the net operating income to the debt. We want a 1.25 minimum. Higher is better. If it's a 1.5, 1.6, that's fantastic. Get up to a 2, you might want to be borrowing more debt. But the deal needs to cash flow day one the way it sits as it is. If you're buying negative cash flow, you're taking a lot of excessive risk, and it may not work out for you. The experience and expertise of the team, it's an old saying, you're betting on the jockey, not the horse. This is probably the most important thing is operations. Have they had full cycle deals? Have they operated these deals before? Can they do it? Not everybody can do this business, okay? It's not for beginners. A mentoring group can't make a great operator. You need people at the helm that are really, really good. I'm not an operator. I'm scared of operating these deals. I want to work with people that have been in the business a lot longer than I have that are great operators. So you want one person on the team that's been operating multifamily full-time for 10 plus years. If you can find a team that's been doing it together for 10 years, that's great. Those are hard to find. Have at least one person with some wrinkles and some gray hair that's been doing it 10 years on that team. The size of the deal, I like bigger is better. I want 100 plus units. Really good operators won't buy smaller deals. So look for bigger is better. Is it easier to manage a 150 unit property than it is a 50 unit property? Yes, 100%. You can bring extra people in. If someone gets sick or quits, you barely miss them. On a 50 unit, you're on the bubble all the time. So look for bigger deals. Bigger is not riskier, it is better. We also want to look at full cycle exits, past investor returns, and the reputation of the operator. One good question to ask is, are you having current issues? Do you have any distressed deals? Have you had bad exits? Have you had capital calls? If you talk to an operator right now that has a large portfolio and they tell you everything's going great and they're having no problems, do not invest with them. They're full of it. Every deal is having issues right now and problems. The whole idea is to overcome the problems. If people say everything is great in their portfolio, that's a sign that something's wrong. They're not being totally honest. And anybody here that operates apartments would agree with me. There's horror stories. It's very, very difficult to operate these. You also want to find out how much money the general partners are investing in the deal. Very, very important. There are deals where GPs put no money in. And I always think it's amazing that they've got this amazing deal, they're selling to it and how great it is, and they're not willing to put their own money in it. So find out what they're putting in. They need to be putting some money in. It needs to be significant. And then also I look at the size of the sponsor portfolio and how fast did they grow that portfolio. Bigger sounds better. When I first got into business, someone they had said 3,000, 4,000, 5,000 doors. I was really impressed. Now when I hear that, I'm not sure how much trouble they might be in with that big of a portfolio, and I want to find out more about what they're doing. Also, I know of people that have gone from 0 to $1 billion under management in 5 years. Those people scare me a little bit. I like more of a gradual, they're buying a few deals a year, they buy a deal, they get it stabilized, they find another one, and it's very linear in the portfolio. So I like that. So be careful, if people are buying everything in sight and they're buying 6 deals at the same time, they may get over their skis. You want to diversify investments in multiple sponsors, multiple deals, multiple markets. Don't have favorites. Have favorites that are your go-to people, but spread it out among different people. If you have a huge exit, you put $100,000 in a deal and you get $300,000 out, it's amazing. Don't give $300,000 to the same sponsor. Spread it out among different people. I work with different operators and I want to spread it around with different people. So if somebody gets in trouble, all of our investor money isn't going to be a loss. And then also always find out, why are the owners selling? Right now in this market, this is a distressed market in a lot of ways. You need to find out from the operator why the owners are selling. And if they can't tell you and it's not really obvious or clear, that's probably not a very good deal. So you need to find out, is it a foreclosure? Is it distressed? Is there a loan coming up? Is this a forced sale? When people have to sell, those are some really good deals. I like those deals. When they have to sell, they have no choice, because when they have no choice, you can negotiate everything. There's total leverage. So look out for those kind of deals with the operators. Accounting and metrics, I'm going to give you some ranges here that most stuff looks like it should be in. So be suspicious of unusually high returns being promised by people. So equity multiple on most deals is probably going to be 2 to 2.5 right now. If someone says they can make a 3, I'd like to see how they could do it in this market. They may, but I wouldn't promise it on the front end. If you're using fixed rate debt, an IRR of 15 to 22 is kind of standard. It could be a little bit above that. But if you see people promising 35% IRRs right now based on the last few years and not knowing where the market is going, that deal is going to run into trouble, or they're over-promising and they're going to under-deliver. There's an old saying, the faster you try to get rich, the longer it takes. And if you're chasing high returns and that's all you're chasing, you're going to have a lot of disappointments. Cash on cash for multifamily, I think about 6 to 9% is a good range. Hopefully you could exceed that, but good operators aren't going to promise more than that on the front end unless they have some kind of an amazing deal out there. Pro forma rent growth, look for around 3%. When rents are below market, it is very difficult to raise rents very quickly. That is a process that takes some time, probably 18 to 24 months. You can't go in and raise rates 15% right away. It just doesn't work like that. You'll get a lot of vacancy. So be careful. Below market rents are good, but you can't raise them quickly. Watch out for large cuts in expenses the first year. It's very hard to go into a multifamily project and cut expenses. You might be able to do it on insurance right now. Property taxes may be a problem. Unless the property is just being totally mismanaged, it's hard to cut out expenses. So a good operator will usually underwrite the expenses to be level, even if they think they can cut them, because it puts a lot of cushion on the deal. Management or construction value add, avoid complexity. I love the mismanaged value add. It's much easier to fix the management on the property and then go to a construction project. Anyone ever heard of tariffs? Anyone ever heard of immigration problems and maybe it's hard to hire people because there's a lot of people that were working in construction that aren't here anymore? It's very difficult right now to do large construction projects. Developing is very difficult, and if a property they're going to go spend $3 or $4 or $5 million in CapEx and rebuild the whole property. I'm not saying that's a bad deal. I'm just saying it's a little bit riskier than finding one that's a gym that's being undermanaged. Fixing management is so easy. And some people can fix both. That's fine, but be aware there's an additional risk factor there. Takeover risk, is the current management a reputable third party? I was a passive on a deal we bought from a Lone Ranger, I would call it, that was self-managing. They had some fraud that was in the due diligence that they didn't catch in the lease audits and things like that. We took it over, and on that passive deal, it's the only one I've had that's been a little bit bumpy. So if you don't have a reputable third-party manager, you're taking it over from an independent operator, there's more risk there, and be aware of that. A good property management company will not collude with the owner to trick you on the due diligence. It's an extra safety that's in there. Reserves, I like 6 months of expenses in addition to the CapEx budget. Some large operators have a side fund where they can kind of rescue their own deals, whatever one's in trouble. That's fine, but ask about reserves on the deal. What are your reserves on this deal? What do y'all have a contingency for all your deals? If the operator looks at you with a quizzical look on their face, that's a problem. There needs to be a lot of reserves. You can't have too many reserves. And then also, once again, beware of unusually high returns in the marketing materials. Do not chase home runs in this business. Real estate is not a home run business. It really isn't. It's a wealth building over time, being patient. If you invest in deals where you get home runs, yes, but it's just like baseball. It's a consistent swing every single time. Sometimes it's a single, sometimes it's a double, sometimes it's a home run. If you're swinging for the fences and going for home runs, you're going to lose money. And I guarantee you, you will not make money in this business by losing your principal. The principal is sacred. It's like the human body. Okay? Once you're dead, you can never do anything again. Once your principal is lost in a deal, you can never do that again. You can never use it again. You can't live to fight another day on another deal. So protect your principal. Be most worried about losing money. That doesn't mean don't invest. It means invest, but be careful about losing money. If you don't lose money, I guarantee the profits will take care of themselves. You'll be fine. If it looks too good to be true, it's too good to be true. If you're suspicious about a deal and it looks bad and you got a weird feeling about it, go find someone else, do a different deal. Sometimes your gut feeling is right. Be really careful about that. Location and market area risk. This is the last one. Invest in markets with above average population, job, and wage growth. Is Houston one of those markets? Hell yes. Is Dallas one of those markets? Yes. San Antonio, one of those markets also. Texas Triangle, good. Austin, I'd be a little wary about that. It's really kind of hard to figure out what's going on over there. Avoid smaller markets. So if it's out in the middle of nowhere, I would not invest in it unless a large market is expanding. Okay? 30 years ago, Conroe would have been a tiny market, right? Is Conroe a good market now? Yeah, because Houston pushed out. Same thing with Katy, Sugar Land, that all happened over the last 30, 40 years. Know the submarket or neighborhood. Avoid high crime areas. They're much harder to operate in. If you're scared to live in the apartment complex, it's probably not a good place to invest. I would look at that. It doesn't mean now, if you live in the suburbs and you do well, when you go walk a Class C apartment complex that's workforce housing, it's going to be a little bit different for you and you may be a little queasy. It doesn't mean there's anything wrong with it, but avoid the really, really rough markets. So be careful with crime. It's very hard to manage out of. Does the sponsor live in the market? If you're in Houston, try to find somebody who's in the Houston area. If you're in Dallas, try to find somebody up there, at least close. You know, if you're investing in Washington State and the sponsor lives in Chicago, that's very difficult to manage from a long distance. Avoid flood zones. They're very easy to figure, and be careful about coastal properties. Are we coastal right here? No, we're not close enough. But if it's like beach view from the apartment complex, I would be worried in case of a hurricane. I like stuff that's 50 feet above sea level. 50 feet above sea level. What is the other natural disaster risk on this? It could be fires if you're in California. It could be earthquakes. It could be special to the location. So find out what kind of natural disasters are out there and know the state landlord and tenant laws and the local eviction policies. The Texas is good. You're good here. It's a little harder to evict in Houston, I think, because the courts are slow. But everything here in Texas is good. So in Texas, you're good. Generally, your red states are going to be better. Your blue states are going to be worse. California, New York, New Jersey, Chicago, you can't kick people out. You can't evict people. I wouldn't invest in this market. It's very, very difficult to manage. And is there new apartment construction in the area? So if you're building or buying an A-class apartment and they're going to build a brand new A-class right down the street and they're going to lease that up, it's going to be very hard to get new business. On your B and Cs, you can't build those really, so you don't have to worry about it as much. But look for barriers to development. One thing you can find, if you can find an area that doesn't want any development at all and they won't allow permitting, that's really good. It means there's no development. One thing going on right now in apartments that's amazing is that it's very hard to develop new properties and almost nobody's doing it. And that is very good for supply the next 2 or 3 years because there's not any supply coming online. If you have existing properties, it's going to be great. And I'm not really a big fan of development when there's so many great deals out there. Why don't you just take the low-hanging fruit? Okay, deal method, art of elimination. You can eliminate deals very, very quickly with this method by not looking at the numbers first. I look at the numbers last. Most investors look at the numbers first. I look at the debt structure, the experience of the team, and the location of market before I look at numbers. The only number I look in the front end is the debt service coverage ratio. That's it. So I can say no 90% of the time, and Stacy can attest this, in probably 3 minutes or less. I don't like the sponsor, it's bridge debt, it's in a bad location, it's in Madison, Wisconsin or something where I don't want to invest in. So I can eliminate this very quick, only when it passes my initial screens, and it's more detailed than I can put in this presentation. Then I start looking at the numbers. Are they reasonable? Are they good? So use that first. Debt structure, experience, accounting, location. Look at the accounting and the numbers last. They're the least important thing. If you have a great operator, a great location, a great debt structure, the numbers are going to be okay generally. People look at the numbers first. I think that's a big mistake and a waste of time. So key points for investors: value consistent returns over chasing home runs. Do not chase home runs. Chase great operators and great locations and people with a great track record. Develop your own investment criteria and principles. Mine, this is what I'm sharing tonight, but I'm not saying it's perfect for everybody. Figure out what works for you and develop that and look for those deals. Look for as many deals as possible. Say no quickly, and once you say no, it's gone forever. Don't come back to it. A no is a no. It's got to be final. The deal doesn't change after you said no. Use your time and energy on deals that fit your criteria and put your goals in writing, and let's take action. So 2 things. I'm going to finish with 2 things, and then we're going to do a little bit of Q&A. The first thing is we joined Total Wealth Academy in December of 2023, and this organization has been a huge part of my success. So if you're not a member, I definitely encourage you to get a membership tonight. And if you really want to jump up and go into the fast lane of investing, I would become a Commerce member right off the get-go. Whether you're going to do residential or whether you can do commercial or you want to be a general partner or whatever, I've done a lot of high-end masterminds, very expensive ones, probably too many. And I can say this is the one I definitely got my money out of, plus just in the first year, and I did a 4-year membership. So I highly recommend Total Wealth Academy. The second thing is, this is a scary time for people to invest. The world's uncertain. I got news for you. It's never going to be certain again. Not going to happen. We live in a crazy world. The stuff going on right now, we couldn't have imagined when we were kids. It's not coming back to being normal ever again. But one of 2 things are going to happen. You're going to go out and invest in assets that grow, that are protected against inflation, or you're going to get left behind. That's the way this society is going. You're not going to be able to keep up with the inflation. I went to the grocery store today. It's crazy. I just don't know how people that are struggling, that are middle class, are even making it. So you really don't have a choice. You've got to learn this stuff. You've got to get educated, or you're going to get left behind.
All right, well, I think we have to cut it off here. We're at time.
Yeah, okay.
Definitely come and see us if you have any other
Thank you so much. We
questions.
so much enjoyed
Okay.
being here.
Thank you.